Aloha, this is Clint Hansen with Maui Luxury Real Estate, and we are on Maui Real Estate Radio. You can listen to this and all shows at mauirealestateradio.com. Search for real estate at mauirealestate.net. And I'm joined by my co-host, Byron Yap of Axia Home Loans. Thank you so much for joining us today, Byron.
Good morning. Thank you.
And of course, Paul Brewbaker, thank you so much for coming and joining us this lovely, what are we in the afternoon now? We've had a couple of hiccups trying to get started with power outages and things of that nature, because while this is broadcasting at the KAOI radio group, 11:10 a.m. at 7 a.m. in the morning, we are actually recording it earlier during all the storms. We tried to do this show yesterday and my power went out. And then of course, Paul is over on Oahu and he had his power go out this morning. So we're starting about 45 minutes later than we were anticipating, but no big deal there. Thank you, Paul. How are you doing?
Good. Delightful day, waiting for the next cold front, but of course, beautiful morning. Of course, the power goes out. So there.
Yeah,
We've had to reboot everything.
There's no rhyme or reason to why the power goes out.
I'm in an old neighborhood. It always happens over here. Yeah.
And same as there's really no rhyme or reason to economics. Obviously there's theories and ideas and philosophies, but we were joking around beforehand that economists have predicted 9 out of the last 5 recessions, which is a little averaging joke, right?
could be 10 out of the last 5 next year.
Depends on the economist, I guess. So we're at our year-end review. We'll actually do this show twice, just at the beginning or at the end of 2022 and the beginning of 2023. So that we can get the best bang for our buck, because Monday, there's a lot of people that aren't going to be going to work, so we might as well hit it twice. And then to just kind of reiterate where we were last time, obviously we saw and listened to the Fed. They were talking about raising interest rates. One of my predictions was we're going to get over 8%, on a commercial rate. So that's 6.5 for the Fed rate. Right now, we're at about 5.5. The Fed's been doing nuclear bomb approach of 0.75, points increase, and they've toned it down to a hammering 0.5 of an increase. So what's that make us now? About 5.5, right?
I don't even keep track.
So we're still.
I'm literally going to look it up as we speak.
Yeah. So we're still a ways away from, of course, my prediction of the Fed being at 6%. That they have one more interest rate, which would make it 8% on the commercial rate. And I've always thought we're going to hit 8 to 9%. They previously said they were going to stop at 4.5, so that's like 6.5 on the regular rate. What are you seeing right now, Byron?
Well, we are seeing rates steadily climb. Some days they go down. It's a lot of the market, what's driving the bond market. Some reports are coming out favorable. We'll see rates drop a little, but it's not where it was in 2021, where it was 3%. It's floating in between 6 and 7 right now, going back and forth. Again, depending on the bond market and things like that.
Yeah, the days of sweet free money are over. So the Fed is doing what they can to tighten down the flow of money, and that's their whole program for what do they call it? Quantitative easing or quantitative tightening?
Quantitative tightening now.
It's the opposite. Quantitative easing is making it easier to get money, and quantitative tightening is restricting that. So I, of course, wanted to bring Paul Brewbaker on to kind of talk about what we're seeing in the real estate market here on Maui. What are you noticing so far?
Well, the drop in sales, of course, and pullback in valuations, which is to be expected given the very abrupt move, very rapid move within 2022, from 3% mortgage to a peak of around 7%. In November, and Byron can correct me now, we're maybe, I'm thinking the range is going to be 6 to 6.5 now for a while. I'm actually fairly optimistic because the Fed, I see the Fed funds rate at 4.25 to 4.5, I think is the range. So, they could go to 5, the cap could go to 5%. Personally, I think they'll be done when they get there. And the long end of the Treasury bond yield curve, at which the 30-year and fixed rate mortgages are, other fixed rate mortgages are arbitrage, is sort of where they tie in. Those rates overshot. Those rates went farther because of the inflation risk premium that existed earlier this year. And now that the Fed has mapped out its course and has largely adhered to it and continues to convey an approach that's perceived as credible, as likely to further bring down the inflation rate. It's been declining in Hawaii since March of this year. Just a note, because you won't hear this on the TV news. Inflation peaked in Hawaii in March at 7.5%. In November, it was 5.8%. I think it's going to be in the 3s and 4s as we descend through 2023. So this inflation event is going to be over relatively quickly. The Fed's approach, as you pointed out, involved deployment of nuclear devices, inverting the pace with which it raised the Fed funds rate in 1994, where they started out at 25 basis points and then ended up at 75. This year, they just went for it all up front, 75 basis points, and now they're tapering to 50 and maybe 25. I think somewhere around a 5% overnight rate, they taper off. And as I observed a second ago, the mortgage rates already, having gone too far, are on their way back down. Where would we end up? Well, think of the 20 teens as a benchmark of the new normal post-Great Recession, post-financial crisis and subprime bubble of the early 2000s. And the mortgage rate until the pandemic was around 4%. I mean, that, to me, that's a really interesting range for it. If you do the math based on the Fed's own conjecture of a long-term or a what do they call it? A neutral risk-free overnight rate, about 2.5%. You'd expect the long bond yields to be maybe 3 to 3.5%, depending on your point of view. And if you add 150 or 200 basis points to that, you get a mortgage rate that's maybe in a range of 4.5 to 5.5% instead of 4%. But that's where we're headed. And as I say, I think as long as the inflation subsidence is validated, we should get there. We're certainly by 2024, we'll be back, let's call it a 4% handle, if not a 4% mortgage rate. So maybe 450 or 475. That would be good money historically. And as a consequence, I think a reasonably firm expectation of recovery in home sales volumes and maybe some renewal of the trend appreciation in home prices we saw in the last decade.
Well, can you explain, Paul? A lot of people get it confused. What is this Fed rate? They always think it's the interest rate. When we hear Feds have increased it to 4%, who does that pertain to for the layman person?
So technically, it's the federal funds rate, the rate that they actually control by injecting reserves into the banking system or draining reserves from the banking system. Literally, they're buying and selling the open market desk of the New York Federal Reserve amounts. They estimate. They have a meeting every morning. They decide how much they think they're going to have to supply or withdraw from the overnight market, depending on what their primary dealer counterparties are telling them are going to be their funding needs that day, with the objective of keeping it at the target, which I think currently is, I don't even know what it is, 4 to 4.5% or something like that. I read 432 on Bloomberg right now. And that overnight rate, which is an important one for interbank funding, right? There are people who you get to the end of the day, you have excess cash, you might as well lend it out overnight and make a little money on it, right? When you're doing big volumes, it makes a difference. But from that point is tied in a chain-like fashion yields on securities at other maturities, from overnight to 30-day, 90, 60-day, 90-day, 1 year, 2, 3, 5, 7, 10, 20, 30 years. And there's a certain amount of mathematics that if you think about it, financial mathematics, that has to connect. They can't go zigzag around, right? Because if they did, there'd be an arbitrage opportunity. You can make money for nothing. So, millions of people trading in these markets worldwide tend to create a curve that ordinarily is upward sloped, but currently has inverted because the short-term rates have been pulled up. Initially, the long-term rates went up because, as I say, there was an inflation risk premium. When you see the Fed bust a move, there's a problem. When you hear your dad talking about, turning out the lights because the electricity bill is too high, there's a problem. Or cutting back on your gas money, there's a problem. And that's what the Fed was doing at the beginning of the year. And I have to say, a lot of people were kind of like deer in the headlights. Wait, what you mean the Fed's worried about inflation? Why all of a sudden are they worried about inflation? And so that risk premium shows up, and that's when those yields, bond yields, exploded. And then, of course, the mortgage rates, which are tied to the long end of the curve, went up. Now, as the inflation risk premium subsides, as the Fed puts on tilts the curve the other way, risks precipitating recession, that is, risks reducing aggregate demand, investment demand for housing being the biggest category that's affected, seeks to tamp down the expectation that inflation will persist, I believe successfully. They can move next year to finishing off at a point, and then later on, and they provide forward guidance on all of this. They published a forecast. They published a forecast last week that shows the rate peaking and then going down and then settling at, whatever it is now, 4.5.
Who did that
4.5.
projection?
The 19 participating members of the Federal Open Market Committee. So Jay Powell, who's the chair, and the four governors, the four other governors, 5 governors, plus 12. I think are there extra governors now? I think we're up to 7 now. For years and years, they weren't being appointed for some reason. Obama would appoint them and the Senate wouldn't approve of them and all this other jazz. But we're up to 19 members, 12 of the federal district bank presidents, and then 7 of whom are voting members of the committee in rotation. But all 19 participants in this monetary policymaking committee submit a forecast, which is then published as the Survey of Economic Projections or something, and published by the Fed, numerical forecasts.
So for simplicity, like if I'm just like for me being the average person, this is the way I understand it. If Fed rates are going up, that means mortgage rates will probably be going up. But the other positive is if I'm not getting a mortgage rate, is my interest that I earn on my money in the bank will go up.
Sure.
Vice
Everything's
versa,
tied,
right?
everything's tied together.
Right?
Correct.
Okay.
Correct. Yeah. Think of what when you say overnight funding, what are we talking about? Banks often will fund their loans by buying the money in an overnight market, right? You're churning the loan origination engine day by day. You've got clients coming in, you're fulfilling their needs. Where do you get the funding? If you're a depository institution, some of it comes from deposits. But in the capital markets now, a lot of institutions simply go out and buy the money. And they make an income off the spread between the cost of those funds and the pricing on the loans that they're originating. And so when the Fed is raising that overnight rate, all the other rates that people are buying and selling money at
So this is a
moving
simple
up.
law of supply and demand, but with money, right? So
it's the same as your farmer's market and any other market. It would be if we had a carbon market, which I don't understand why we don't. And you asked earlier what's connected, and the credit cards, for example, often will have pricing. If you go read the fine print in your terms of service, they'll have a connection either directly to the Fed funds rate or to rates that mirror that Fed funds rate, like the prime rate and other, because they're sort of they're really indexes. They're not actual rates, but they're indexes that banks will use and legally, contractually commit to adjusting their pricing as those market rates move around.
And personally, we've seen this definitely affect both of our markets, the mortgage and the housing market. You know, the thing is, we're not really seeing a decrease in prices, not significantly anyway. Definitely decreases in volume of sales, but it's been mirrored by a lack of new inventory coming on because so many people have refinanced their properties at, you know, drop dead crazy free money rates that they are not needing to sell their condo, which is still renting incredibly well, whether that's long or short term. You know, that's their primary residence, and you know, their mortgage rate is so low, there's never any way they'd be able to replicate that with rent. So there's very little opportunity or need to sell for most people, starving the amount of inventory coming on the market, which is always especially difficult in Maui, given the difficulty for building here and the high demand for properties as well. So fortunately, we're on the political front, we're starting to see a reprieve as the county finally got the idea of issuing bonds. So there's been like 5 developments that have been approved, and it's based on a simple mathematical equation. If the property is worth $1 million that they're building and they're going to sell it for $500,000, then the county will issue a bond for infrastructure improvements. And then to make up that difference, the bond gets paid for by the new real estate. And then in addition to that, in my opinion, most importantly, is the fact that with that that new supply that comes on the market, it's specifically designed to help local people, doctors, and you know, anybody that lives and works on island here. Of course, it is thousands of homes that are coming on, but it's not enough to meet the shortfall. I mean, we're talking about 10,000 homes that were short for local buyers on the island. And, you know, while over the next 3 to 5 years, we'll see an extra, you know, 2,000 or so, it's only a small, you know, dent. And hopefully this will continue and we'll see more development, but it's a long ways. And, you know, the big concern is, as we're starting to see like the very few affordable housing developments that are on the books that are slated to be finished in the next several months, you know, and there's not a lot of them, is how many people are going to drop out because of that higher interest rate, meaning there's going to be properties that are going to be open to open market, you know, and those even aren't, those ones that are getting built now are not the ones that are discounted. Those are, you know, still on the affordable range, but not the same new law that's getting, or principle that's getting applied. So that being said, and what you're seeing with looking at the numbers, since I helped give you access to the Real Estate Association of Maui's feed, what are you seeing the historical relationship between the lower rates, the current rates, supply, and everything?
I think before we look at the housing market, and we will, it's important to reflect for a moment on what you just described in terms of the home building strategy. If I understood, I haven't paid that much attention to it, and I'm not from Maui. Mm-hmm. But it sounded like you said the county is going to invest in infrastructure, and then somebody's going to build the houses, either Correct. A nonprofit or a for-profit. It doesn't matter. A nonprofit is just a for-profit with the executive director driving around in the profit. So that's mm-hmm. how that rolls. And well, that's the way it's always been done. Everywhere. Well, and at some point, the jurisdictions in Hawaii seem to have decided that schools and roads and infrastructure were going to be provided by the developer rather than by the jurisdictions. I don't know who came up with this idea, but you know, I had a meeting the other day about tourism over at the Ledge, and John DeFries, who's the head of the tourism authority, was sitting in the room, and he's the HTA CEO. And so we're talking about tourism. And afterwards, I went and chatted with him, and I said, "Hey, John, you know, last time I saw you was 2009. You had just built the county of Hawaii a road, and they had just told you that you couldn't build your houses." So John DeFries was running a project called Hokulea. He built them a road, And then they told a judge or somebody, Judge Ibarra, told him, you know, you only think you have entitlement to build the houses. You can't actually build the houses. And we literally were having, the financial crisis is going on, and we're having lunch at this beautiful clubhouse that they built at the golf course, surrounded by none of the homes that they were going to build because they're no longer allowed to. And this is the guy running the tourism authority now, so he found a new life. But he never did get to build those homes, but he did build the county a road. So I don't know who thought that it was a good idea, but here's another good one. Wait, the county's issuing bonds now at these rates?
Tax credits and bonds. So basically,
Yeah, but I'm saying, why would you be bond funding now after interest rates have gone up when you could have done it anytime in the last decade at much lower rates? In fact, I believe I had that conversation with people from Maui County in 2020, and that petered out. And then, yeah, tax credit, you know, I mean, we have an affordable housing, there's a production problem. And this is the point of what I'm getting to. We just don't build enough houses. These are the Neighbor Island data. And these are Neighbor Island data for 60 years through the middle of this year. You know, and here are the actual data in the upper left. So we're building on the neighbor islands generally, and this is true on Maui, about the same amount we built back in the 1960s. Okay, you know, without computers, with slide rules. And if you look at the trend, we're back, as I say, to where we were in the 1960s. I mean, everything that we're looking at here, the cycle of the last decade was suppressed by regulation in the neighbor islands, right? The affordable housing requirements, what they call them inclusionary zoning requirements, but they're just production quotas.
yeah.
And so they throttle production, which is the point. The advocates say that it's to get builders to build more affordable housing, but the truth is that the advocates don't want housing to be built. Period. So that's why we throttle it. So you know, just to make the point here that I don't know, timing. The timing is. It was always true that if you built homes, it contributed to the property tax base, which thereby contributed to infrastructure funding. And secondly, if you're doing something like producing water delivery infrastructure or producing roadways, anything that has a flow associated with it, it's possible to charge a price, meter the throughput, right? You can scan the roadways and you can measure the flow of water. Typically, departments of water supply, like on Maui, or boards of water supply on Oahu, they charge you a fee that has to do with the infrastructure, but not the water itself. So nobody's actually paying for the water; they're paying for the pumps and the electricity and so on. And so getting that pricing right, how much do you pay to drive from Kihei to, Wailuku to your county government job every morning in rush hour traffic, or how much do you pay to drive from upcountry down to whatever? You pay for it in congestion, but you don't actually pay a road fee, which you could just put up scanners and, you get a bill every month that would show with surge price at like Uber. These are all algorithms now. So there's no toll booze. And, jurisdictions who don't want to do that end up where Maui is with lots of problems. Maui has more registered motor vehicles than it has residents, right? You don't want to do anything about that? Okay, I'll get off my soapbox. I'm saying there are other ways to do this that are, more effective than this way we're throttling production now, which has created this problem, and then come in at the back end and try to.
Well, hopefully they've gotten over that. I mean, the reason they're so used to the idea of developers putting in the infrastructure is because, specifically Kihei, back in the 70s, when it was the middle of nowhere and nobody wanted to be out here, they would, developers, Canadian and Californian developers would be like, hey, we want to put in this condo, this hotel, or whatnot. And the county would be like, okay, you can do that so long as you're going to put in the infrastructure, and whether that's parks, roads, sewer, and whatnot. And when labor markets were low and material costs were less, it was relatively doable for a developer. Of course, those are completely changed. And in addition to that, Kihei is now relatively bustling compared to, well, it is just a bustling place. I mean, lots of people want to be here because of the same reason they want to be in Lahaina, awesome weather and close to white sandy beaches. Now the county seems to have gotten the message with their new policies and implementations. It's only took 20 plus years of hammering that idea home. And hopefully we'll see the fruits of those labors over the next, coming decade. Obviously there's other programs for subsidized housing, like my family helped start Nahalio Maui, which is, in my opinion, not the ultimate solution, but an important tool to use. It's a community land trust, so it's affordable housing in perpetuity. Of course, they've got apartments that are affordable in perpetuity as well. It's hard for the people that are in there to make lateral moves with such high real estate costs, because all of a sudden, let's say you get a raise, they're going to kick you out of your place because you don't qualify anymore. So you're damned if you are actually succeeding at your job.
Let's give people a disincentive to raise their productivity and earn a higher income. I mean, I understand why people are interested in the model. I think like you that, be careful what you wish for is all I'm saying. I mean, you remember the leasehold catastrophe, residential leasehold catastrophe 40 years ago. That this new stuff sounds like that. And all I'm saying is, if builders can build, they will build what people need.
A lot.
What's that?
Nahalio Maui is, of course, a 501c3, and it's a revolving board to, and their mission statement is affordable housing in perpetuity.
But, I said this a second ago, and nonprofit, it sounds like a good idea to people who don't know
it's
economics.
It's not, in my opinion, a solution. I think it's an important bridge.
A house costs what it costs to deliver, and then somebody has to pay for it.
Sure.
So whether it's produced by a nonprofit or a for-profit, it's the same thing either way. It's got to be produced, which has a cost, and somebody has to pay for it. Somebody has to pay for the plate lunch. You can subsidize it or not. I'm just saying there are more efficient ways to subsidize. I understand that some people will need housing subsidies, but you want to be careful not to design a system that condemns a person to live in a low-income neighborhood, because the minute they go to Maui College and get upgrade their skills, go finish their apprenticeship program, become a journeyman, whatever, and they get a raise, they got to move out. And you haven't solved the problem for the rest of the housing market. So I'm just saying, the solution is all of the above, and we're doing some of the above, but we're hung up because you wanted me to talk about the housing market as opposed to home building. Home building only drives me crazy is because in the last decade, in the 20 teens, with computers, we built about the same number of houses on Maui and on the neighbor islands generally as we did in the 1960s. And some people think that's a good thing, and that's why your children are leaving. So that's all I'll say about it. Turning to the existing home market, I think it's worth looking at the data on. Now, this is a rough cut of a graphic that the boys here and I were just making before taping, but you can see that inverse relationship between the mortgage rate on the horizontal axis, the x-axis, as mortgage rates go up, the inverse relationship with sales, which go down on the vertical axis, on the y-axis.
Sales, right?
These are monthly data for Maui from the Realtors Association for the last 10 years, 2012 through November 2022. And you can see there are a few outliers here from that. And we'll take a look at those outliers in the next slide, which turn out the ones in the lower right over here on the right side of the screen are the last 3 months. The ones that punched out at the top are at the peak of this post-pandemic surge in home sales and prices in the summer of 2021. And the one peeking out from the ellipse at the bottom, this is the entirety of the last decade. And now we're looking at just the data since this outlier in May of 2020, when the first shelter in place emergency order was rescinded, and home sales, as you can see, jumped from 100 to 200 to 300 to 400 transactions per month within about a year at these low 3% mortgage rates that were a product of the Fed's monetary policy at that time, a policy of low interest rates to provide a bridge as the economy went over the chasm that was the initial year of the pandemic, trying to sustain economic activity and in the housing market sustain home sales, and quite successfully, you can see. Now, you might ask, where do we go from here, where the rates have probably peaked at 7% this fall, and will be working their way back to maybe the 6s and the 5s next year. And we talked earlier about ultimately a mortgage rate that might have a 4 handle on it. And you can see from the last recession, from 2008 through 2012, the path being laid out again in a transition from about a 6.5% mortgage rate to the a 3 and 4% mortgage rate we saw in the early 20 teens, which is where we may be headed. So something like this, for those of you that are streaming online and watching this, something like an arrow that I've replicated from that early 20 teens experience.
Moves back to
say a 4.5 or 5% rate, which might be the equilibrium long-term rate, or the so-called neutral, the one consistent with the neutral Fed funds rate. In terms of valuations, what you'd expect, and home prices have been pulling back this year from the peak that was associated with this little post-COVID bubble. I'd expect they will converge back to this underlying trend, which would have gotten us to 1.2 million for the single-family home segment by 2024. Anyway, we overshot in this post-COVID adjustment, right? The remote work, kind of everybody deciding whether they actually want to live in a Zoom town or in an urban area, and people moving both directions, people leaving Maui, new people coming to Maui. Same thing happening in the condo market. That's partly a function of a shift in the, right, you mentioned earlier, there's a lot of condos in the short-term rental pool on Maui. Those are mostly small investors, not all local, but many local investors. It's sort of like the democratized wing of the lodging industry. The lodging brands dominate in the destination resorts, and then the more individual investor-oriented market segment, maybe a third of all the lodging inventory on Maui, is clustered in these condo developments with individual owners, often managed by property management groups. And in that market, there was when the initial 6 months of no travel came, a bunch of small investors got blown out and chose to divest or to invest in other asset classes. And that change of ownership, a new wave of buyers came in the last several years, peaking in terms of volumes in the summer of 2021, and then peaking in terms of values in the summer of 2022. And here we are, looking at reversion to trend in terms of values and a subsidence of sales to the bottom of that clockwise sort of rotation in interest rate sales volume space.
So that is beautifully displayed on there. I think, of course,
I love the patterns. I mean, you just, you look at it, you go,
now,
wow, there's an actual
all
pattern.
you need to do is stop looking into the past and tell us what's going to happen in the future so we can make decisions. Okay.
Well, I'll conjecture a couple of things. One is that I showed a transition from 2008 to 2012 that took 4 years. I don't think this one's going to take that long. I think this one will be over in 12 to 18 months from where we are now. So I think 2 years all in, maybe 2.5. You have to remember the inflation that we're experiencing now. If you're looking at the Hawaii data, which I don't know why you wouldn't if you're in Hawaii, the inflation began after March 2021. So think of it this way, about the time everybody started to get vaccinated and felt like they could go out again, the inflation showed up because we all went to go buy something, and we got a check from the federal government, a stimulus check or something. We paid down our credit card debt in the 2020 stimulus, and then we tried to buy a Ford F-150 after the 2021 stimulus. And the problem was all the chips were being made in foundries in Taiwan that hadn't ramped up yet. And so you couldn't get your Ford Bronco delivered for 12 months. And so that jam up in the supply chain created a demand event that outstripped the global supply chain's ability to fulfill the demand. There are two pieces. One was everybody got a check, right? 800 billion in, we call them, what were they called? Paycheck Protection Program loans. They weren't loans, they were grants. The federal government gave 800 billion to small businesses. We have a housing problem, we can't give money to poor people, but we can give 800 billion to businesses in, what did we call them? Forgivable loans. And for those of you on radio, I'm doing air quotes, forgivable loans, also known as free money. And so that happened, and checks to every household, and so demand outstripped supply. Then things on the demand side, and then on the supply side, the empty containers are on the wrong side of the ocean, so it took a while for things to reorient. We would have been done with the inflation that started in 2021 within a year, because it was that one-time event, and then Russia invaded Ukraine, which meant another year of high oil prices and high grain prices, right? Ukraine is the fourth largest wheat producer on the planet, et cetera, et cetera. The huge manufacturing producer in Central Europe. And so we had another year. And in fact, if you look at the data, another round of inflation coming from the energy complex, coming from food, energy, right? Food and vehicles. Those are the three components of above average inflation in Hawaii, right? If they're above average, they're pulling up the average. And now they're reversing. Oil went to $120 a barrel. Now it's $80 a barrel, right? People saw the high oil price, saw the high corn prices and wheat prices, and tried to plant into it last spring outside Ukraine. And of course, ran into drought and, climate change and other complications. So the grain markets continue to be, and it's always something, right? The coffee borer, has it gotten to Maui yet? The coffee borer and the coffee fungus over on the Big Islands reduced coffee yields by a third. But my point is, there's always supply side and demand side shocks. Some of them are catastrophically massive, like the pandemic itself. And as it turns out, the reverberation from the war and the Russian invasion of Ukraine, all of which eventually settled down. And we're probably at that point now. The inflation rate went in March 2021 at 2% to 7.5% in March 2022. And today it's 5.8% last month in Hawaii. So it's reversing that 1 year increase with another year's worth of decrease. And I think next year, as I say, this thing's not going to take 4 years to revive the housing market. It'll probably be
unless my black swan ends
yeah,
up coming
or
true.
something else happens, right? We were all sitting here at the end of last year having the
You
same
remember what my
conversation.
prediction is?
No.
So my prediction is, for my black swan, is the securities, the bottom dropping out of the securities, the commercial security space for office. And I've made that for the last year, where I think that while we're seeing massive vacancies across cities, and the idea to repurpose those spaces, and that's definitely big intent, the cost is just impossible, because it'd be cheaper to tear the building down and start up to make apartment buildings, as opposed to, retrofitting. And I for our previous conversation, retrofitting is like $1,000 a square foot or something like that. So, that makes it just kind of impossible to fill the new demand for housing that's necessary. I mean, there's almost 3 million homes that are needed across the United States, 1 million of which is in California. So we still have massive demand issues everywhere. And then we have these city centers, which have anywhere from 20 to 50% vacancies on office space. And we were discussing hey, companies, as the recession is coming up and people are cutting costs, they're still keeping labor force. I mean, labor is super important and they're letting people work from home. So I am of the theory that they're just going to be walking away from their contracts in droves for office space, working more remotely. You're going to see these securities, because commercial securities like office space make up a much larger percentage of the securities than residential. So I think similar to the subprime crisis, we're going to see, another basically liquidity issue, but more centered around those securities as opposed to residential securities. And I think that's the next black swan that's going to push us into the recession coming up, in the next, bit. But I actually think that the opposite end, which who knows when this is going to happen, but I really do think that the singularity for computer power, where artificial intelligence is about to make, scarcity a thing of the past, is just about to start. I think we are a year or so away from the singularity where you have computing a power that can basically, you talk to it, like Chat GPT is a new one that just recently came out. You saw the video that I shared with you last time about on the creative space for images and whatnot. Now, that being said, I think programs and app ideas are going to be able to be generated just by simply typing in a few basic prompts and ideas on how something's supposed to function. And you're going to see massive explosions in productivity that are going to help change the economy. I think it'll create another bubble, and then we'll see where it goes from there. This is probably like a 10, 15-year cycle that I'm talking about. But I think that'll be the next black swan, and then that'll be what pulls us out of it. My guess, of course.
I'd be less concerned about the transition in the office space in the following sense. So it's important not to put too much weight in the experience we had in 2007, 2008 in that financial crisis, which was originated in housing. And, housing is pretty broad segment, but became problematic because of mispricing of derivatives and so on that led to systemic financial collapse. I don't see the office, the CMBS in that particular line of business as opposed to industrial or retail or lodging. I'm not sure that office has sufficient exposure to create the same kind of systemic problem, but it's a risk that'll have to be mitigated and managed. There's no question there's excess office inventory. I can tell you the Hawaii data alone, I just happened to look them up recently in the American Community Survey. We've gone from, you can look it up for Maui, or I'm not sure about that. I have looked it up for I think I did look it up for Maui. It's not as profound a shift on, I'm sorry, I don't remember off the top of my head, because I did look up Maui and Oahu and then the state as a whole. But roughly speaking, statewide, we went from about 5% of workers not commuting, right? Working remotely full-time pre-COVID. And that was the same all through the 20 teens. And then suddenly it jumped, and now it's 10%, 10.7%, something like that. So it doubled. And then of course, there were always hybrid workers, some people who didn't go into a formal workplace every day of the week. And that maybe took the total from 5 to 10%, which then doubled to 20%. So 10% working remotely full-time, another 10% working in hybrid arrangements. And we have validation of the 20% from surveys this fall that the Census Bureau has fielded called the Household Pulse Survey. So we have the American Community Survey, which is ongoing, and then we have the Household Pulse Survey confirming, just fortuitously, from July through November, they just happen to be surveying remote work. And so we know how much the landscape has shifted, and therefore how much of what's happened in the office market in downtown Honolulu, we've gone from 10 to 15% vacancy, for example. How much of that is permanent? I would say all of it is permanent. And then to your point, the challenge from a variety of standpoints. One is the cost of, it sounds easy to convert an office building to a residential structure, but you don't have the plumbing, for example.
Absolutely not.
Whether you scrape the building or not is another, question entirely. Whether $1,000 a square foot, it seems expensive until you think about what it might be worth for people who want to live closer to. Anyway, I'm just saying there's opportunity for entrepreneurs. There are risks for risk managers to be aware of. And then in the, I'm sorry, I lost my train of thought. Oh, in the lease renewal space, you have to remember a lot of tenants continue to be in leases that don't roll over until sometime down the line. So we won't see for a few more years how many tenants re-up their leases and how many have decided, because some of their staff are working remotely or in other arrangements, they can, working from home or elsewhere. I mean, it's changing the nature of the workplace itself against the backdrop to which you all also alluded of a very tight labor market, because, enough people left the workforce after COVID and aren't coming back, 55s and up, and enough people ran into perceptions of risk in customer-facing workplaces and retail and food service, in childcare, where the young people very often who were employed in those professions have chosen not to expose themselves to those risks and maybe build some human capital through higher education or skills, training in industrial arts and whatnot. And then finally, we don't have the immigration that we used to. So the pandemic shook things up.
We actually have had record immigration though this last year. Some of the most immigration we've seen in decades, almost like 1 million new visas or something like that to the US, which is great, and a massive reversal. So now we've actually had tons of legal migration, which is.
But I also meant in Hawaii, where we've had net out migration.
Correct.
And
yes.
Well, both are a problem. And I know it's politically contentious, but most immigrants to America are on average of higher skill than the workforce in situ. And then that's true if you look at the net migration statistic for Hawaii.
It's not Hawaii.
No, Hawaii, it's true too. The people who move tend to have higher educational attainment on average than persons who don't move, than residents on average. That's moving in and out. So people with higher educational attainment tend to be more mobile in general. But in Hawaii, we lose, people worry about the brain drain. Well, we also gain because the point is that moving around is a good thing. That's what makes America great, because
it's an open marketplace.
It's an open market. We have the Interstate Commerce Clause. You can go do your business wherever you want, and it's subject to the local laws and regulations and whatnot. But you're free to move around the country without a visa, and so labor and capital can reallocate spatially to where they're most productive and therefore most highly rewarded, and that's a good thing. So COVID interrupted that for a while, and indeed, for the 2 years after COVID, half of the price appreciation in housing in America in 2020-21, half of it came from remote work, people busting a move, and then all of the productivity growth in America in the last year or two came from remote work. So it's a one-time big shock. It's over. People sort of move to where they're going to be. HR departments have decided how they're going to set up from here on out. And we're looking, as you say, for the next source of productivity impetus that may be AI, as you say. If you just think about management reporting, right? You think about all the drones you got in your company that are doing the bookkeeping and accounting, and there's going to be a system that allows the big data to be harnessed and turned into a management reporting vehicles that get you a better fix, better, faster, cheaper, right? And that allows you to redeploy human resources to more productive tasks as well, or enable them to acquire higher order skills and attain higher productivity. So it's all good. There's a lot of potential there. I worry a little that there's a dark side to it, which is Elon Musk owns Twitter, and how did
Well, you
Facebook
just
work
got
out?
apparently voted to step down as CEO on a public
Well,
poll. Follows that,
yeah,
but
I own the
I always find
company.
it
Like,
funny
I'm
that
going
he
to
got
take
rid of
your word. I care about your opinion. But I'm just
Yeah.
saying, there's a dark side to social media that I don't think we've reckoned with, and so we're going to have to be vigilant with respect to AI as well, because there's a
Yeah.
potential there for mis and disinformation on a scale and of a quality that we haven't seen before.
Yeah, hopefully it'll be the end of weaponized information, and then they'll actually put robots and AI in place in order to put some sort of objective
No,
truths out there, or at least an alternate understanding of certain facts, so that people can get a more rounded perspective as opposed to something so one-sided. But the way that social media is right now, and in fact all media, that includes major networks, is it basically forces echo chambers. And in fact, the only marketable way in order for media to exist is now for these echo chambers, and that goes on both sides. Whether you're talking the New York Times or Fox News, you have these groups that get in, and whether it's the as they say, over wokeness of culture and the diverseness, or the overleaning of the Republican side, you have a tendency to just create these places that only foster to your group, as opposed to having a diversity of ideas, which is the foundation of the US. So now that marketing towards those unique groups can cancel culture on both sides, and this is not one side or the other, and how the economics play into media needs to be addressed. There needs to be more well-rounded discussion, because I have family and friends that are on both sides of the spectrum, and I'm okay with their opinions, whether I agree with them or not, and they'll still be my friends, they'll still be my family. And there needs to be less just hatred for an idea that you don't agree with. And until there's some mechanism to do that, whether that's even legal with the way our system works, is major issues that need to be controlled, especially with massively powerful tools such as AI and bots that have already been around for almost a decade. So it's scary, and also very promising what we're hopefully going to see in the coming years. So
from an economist, from an economics viewpoint, what I would recommend is that people think about the way markets work when markets work well is when the boundaries are well established, right? When you teach undergraduates, what's the role of government? The first role is laying down the rules of the game and an enforcement mechanism, right, for property rights and whatnot. So that rights are well established and the boundaries well developed. And when you talk about the different forms of media that we have now arrayed in front of us, at one end of the spectrum, we have an old school sort of journalism part of media, where the mechanisms were designed such that you are liable for speaking an untruth, right? You are liable for libeling people, or there are legal consequences of straight up lying. That's not true, right? We took that away in the 1990s. We took that away from social media. We left that out of a lot of the internet, because the idea was, well, let's let the internet prosper. And now we know, because we don't have those boundaries, right? A social media company is not liable for the content, as opposed to a publisher.
On a world side, there's basically places
It's
like
even
Facebook,
worse.
Meta.
It's even worse. No, I mean, companies like Meta and Twitter, they don't even right. There's no obligation there's no obligation for them to manage content globally, right? Twitter doesn't.
Even though they've asked for some sort of platform.
Well, jurisdictions ask, and Europeans, I think, are at the front of this, and there are groups agitating the US. But my point is that we let the horse out of the barn or whatever, and now we've got to figure out what the boundaries are and where the liability should live. Because there has to be liability for content that leads to untoward outcomes, right? You can't, that, right? The other roles of government, creating rules of the game, producing public goods, right? Like infrastructure, and correcting externalities, the unintended, uncompensated spillover costs or benefits, but we're worried about costs now. I do something and it unintentionally harms you. That liability, in many cases, should be put on the person who, I created pollution and therefore you died of a chemically induced disease. That kind of thing we've long recognized is something that we the people, the government, should be correcting.
Now, I know we don't have a whole lot of time. We have about another 8 or so minutes left in the show, but I was wondering your opinion on the shift in government policy for funding and helping the less fortunate individuals and minority groups in acquiring property through, loans. Like they've of course had the VA loans that are available, which is fantastic as a form of you're helping the United States, but say there's a less advantageous group, whether that's economically or by race. How is that coming into play? I mean, I have heard of some rumblings and some institutions starting that process, but I haven't seen any like actual practical applications.
Speaking as I used to hang out with bankers. I'm not a banker. I used to play one on TV, but maybe this is something we should kick over to Byron, although I'm inclined to think that Byron is going to say, hey, we do loans, whatever the rules of that game is, we adhere to all of them. In banking, the history is that in the mid 20th century, we recognized how unfair lending was. And so we introduced in fair lending policy, fair housing policy, so on, policies in the 60s that removed the discriminatory barriers that had been in place, either just because they were customary or for more malevolent reasons. And so by the time I entered banking in the late 20th century and spent a quarter century or so hanging around those guys, my two takeaways were that the banking system broadly, and I include Byron and the mortgage lenders and so on, right? There are some lenders that are deposit takers. There's some lenders that fund themselves in more creative ways that are directly tied to the capital markets. But however you do lending, the way it's done within the commercial, what I'll call the commercial banking system, but intend to include everybody, is really, really efficient. It's informationally efficient. And the tools that we use, because there is discrimination, you have to discriminate between somebody who's going to pay back the loan and somebody who is not. That's right. That's the key. It's literally called discriminant analysis. The key threshold is not to give loans.
How do you work in policy that basically gives reduced rates for disadvantaged?
Well, and there's my second concern. The system is really efficient at doing it if you have a policy that creates the level playing field to which I think we all aspire. So, for example, until subprime lending, and subprime took a lot of heat, threw a lot of shade, got thrown in a lot of shade, went too far. We all understand that. But under solid loan underwriting, mortgage loan underwriting guidelines, right? There's a place for a loan to a lower credit quality borrower because her experience, a single mom who's paid her rent on time there for 10 years. There was a time when that person could not get a loan. And now if you look at the composition of households, right? In 1960, 60% of Hawaii households were married families with children. Today, 20%. In 1960, 12% of households were persons living alone. Today, 24%, right? The nature of households has changed. And so between fair lending, more access, better underwriting, it's all in the math, you guys, better math, better AI, better algorithms, and a different kind of housing market. We've done a pretty good job in the private sector where the incentives are correct. If you make a bad loan, you lose money and then you lose your job, right? It's got the right incentive structure. And my concern is when we turn this activity over to government agencies, which do not have the same incentive structure.
Or
And I'm not
tools.
going to name any names, or maybe the tools and the training, but many of those individuals that I know personally have spent time in banking and know the way it should be done. My concern is that when I look at the list of acronyms of agencies that are getting into this kind of activity, it's not impressive. They don't have an impressive track record. They don't have an impressive loss history, right? If you look at their
They just take advantage of an
loan
opportunity,
losses,
which is what
well,
business
they
does.
get paid either way
Yeah,
because they work for the
they're not
government.
altruistic. They're just doing their job.
Well, everybody's doing their job. My point
Yeah.
is that the rules of the game are different in the public sector, where you don't lose your job for doing a bad job, and you don't get a bonus for doing a good job, right? From the way the rules are set in the private sector, where those incentives do matter. And so that's, again, if you have the boundaries set correctly, it's more efficient to do a lot of this activity in the private sector, if at all possible. And maybe rather than subsidizing in kind by building somebody a house and allowing them to live in it for less than it costs to build, or by juicing the loan, making fake loans that people aren't going to pay back. Maybe you want to just subsidize the household, right? Just provide the rental subsidy. We already do that. Do we do enough of that? Maybe not. Do we produce enough rental housing? Maybe not. I'm not talking about subsidized rental housing. I'm like rental housing where the subsidy goes to the occupant, not to the builder, because they're a nonprofit. So, these are all things we need to think about. I tend to trust, having lived in the private sector, I tend to have a lot of faith in the way it does things, has the capability of doing things. Again, if the boundaries are right and the mechanism design is.
Byron, have you seen any changes in the pipeline of these kind of new subprime policies in the future to help disadvantaged groups? Because I know it's something that they're just sort of mulling over now.
There is some lenders that are offering programs for that. Of course, the rates aren't as favorable because maybe there's a credit issue or something like that. I believe there's a company called Chains Wholesale, which has like backers from Netflix, Amazon that have put money into this fund to help the disadvantaged communities, lacks the guidelines a little, but you got to remember, it's like with anything like Mr. Brewbaker was saying earlier, you add a little more risk, there's going to be a higher rate because there's a little more risk. But on the positive side, that person or that family couldn't get in. They just need to be educated. Hey, you're going to pay a little more for the risk, but you get the home that you want.
To me, that's why Nahalio Maui is so important, though, is not because it's, the fact that it's subsidized housing. It's the fact that it's a gateway to the open market. The majority of people, like 75% in this, relatively newer program, it's a little over a decade old, is 70 or 80% have transitioned to open housing. So these people who are not really owners, but they're co-owners in a property still apply and can be first-time home buyers, which, obviously it's not a solution to everything, but it is a phenomenal tool that I think is one of the many roads to home ownership. And I've always been a big advocate of housing first. And hopefully we'll see better policies, reductions in costs, and where public and private partnerships come together to help everybody live in a productive environment. And until we have better systems in place where, it's not collapsing the economic system, we're going to continue to go round and round on these major ups and downs. And one day we'll get there. Obviously, it's never a perfect science.
Well, look, this is a tale as old as time, as the song says, and we all started out when we moved out from our parents' house and lived in some crappy ass apartment, and for which the rent didn't seem to be worth it. Moved on up the food chain. That's everybody's life, and to make it easier to do that, make it more clear to first time. People moving out of their parents' house, that's what we're talking about, and moving through their life cycle in their 20s and 30s and having kids before they were ready, and all of the thing everybody does, right? helping them along is really important. I don't know the specifics of the project to which you referred, but I do know in Byron's world, more than half of all mortgages today are originated online. You have to think about that for a second, which means
Not so
they're
much
being
about
done,
it.
they're being done algorithmically. And to the point both you and Byron were making, these people that are building these engines and using the new math and using the big data, who can identify much more finely, delineate certain sources of risk from another, should be capable of filling a gap, right? What we do now is, you get this FICO score and you get that FICO score and you use this sticky with the higher rate. They're looking to fine tune and make that a continuum where the individual circumstances, can be
Quantified.
mapped more finely to the design of the loan structure that they're going to be in. And I think more broadly, it's about, one of you mentioned this, helping younger households, younger families realize that they're on an escalator, right? They're not going to live in the same place for the rest of their lives, most likely. Certainly not once they start having kids. So to understand that it's a dynamic and changing process, they should be thinking about their future, their children's future, what happens when they're grandparents, and
We're going to have to wrap it up there. We're just at the
One
end of our
thing-
time.
One
Thank you
thing I
so
want to
much
mention
for all your
before we go.
insight. Go ahead.
One thing I want to mention for Paul, Karen grew up with you in school. She listens to you on the radio when she hears you. From Elaine's Cookie, she's a friend of mine. She goes, I love hearing Paul when you guys talk to him. He's a high school or neighbor or something. Karen,
on Willie Elementary, most likely.
There you go.
All right.
Okay.
All right. So yeah, again, thank you, Paul Brewbaker. I really appreciate all your insight. It's been fabulous to have you on the show. Byron Yap of Axia Homes. Is there anything you'd like to say?
Just have a great day. It was a great conversation and we'll all get through this together.
And mahalo, this is Clint Hansen from Maui Luxury Real Estate. You can listen to this and all shows at mauirealestateradio.com or tune in Mondays at the KAOI radio group at 7 a.m. in the morning. Aloha and have a great day.
Thank you.
Melikilikimaka, boys.